All right, welcome to the webinar, everybody. Thanks for joining us, taking some time out of your day to be part of the webinar. My name is Clay Malcolm here at Advanta IRA, and I'm joined by Emiliano Zapata, CEO of Capital Insiders. Emiliano, thanks for joining us today.
Thank you.
All right, so I'm going to go ahead and kick off the presentation with a little bit of information about self-directed IRAs, especially for those who are new to that kind of idea, and then I will turn it over to Emiliano, and he will go through the bulk of our presentation today, which is really about managing loans that are based on construction and the techniques that he uses as a professional, so that all of us investors can learn a little bit about that. All right. So here I am. I have been in the business of self-directed IRAs for about 10 years, and I'm also an investor both inside my IRA and outside my IRA. So a lot of the presentations that I put together with guest speakers are helpful to me as an investor because I'm learning as you learn as well, because I'm one of the investors alongside you. In fact, the presentation today with Emiliano started with a phone conversation that he and I had about some of the things that were going on in his business and how he sees his lending business and things like that. So I thought it would be a good topic for us. So I'm looking forward to his information as we go. Now, all the information in the presentation today is for education purposes only. At Advanta IRA, we do not give tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. Our role in the equation is a very neutral one, where our job is to document the activity of the account so that it gets to keep the tax advantages, even though it's investing in alternative assets rather than Wall Street type publicly traded securities. And we certainly encourage you to talk to your financial team anytime that you are considering an investment for your IRA. That could be your attorney, your CPA, your family, whoever it is that is your financial team. Now, Advanta IRA is a provider of self-directed accounts. We handle all kinds of accounts and almost every type of asset that is out there. We try to give you a wide range so that you have the ability to adjust to market conditions or to invest in your expertise. And we've always taken the position that one of the most important things that we can do for you is provide excellent customer service. The alternative investing that we're doing is very idiosyncratic, and it takes a lot of communication between the custodial entity and the investor to make sure that the paperwork is has the appropriate documentation and things like that. So we feel like our best service to you is our personal service, where you can talk to people about what it is you want to accomplish, and we can help you do that. A couple of things that we do to back that up: we certainly have very long tenured employees with a lot of certifications. So we try to keep ourselves educated about what's happening out there, both legislatively as well as from an investment standpoint. Uninvested cash is FDIC insured, so that while you're either receiving cash for investment or you've positioned cash prior to making an investment, it is FDIC insured, just in case the bank has a problem. So you're protected in that way. We're a medium-sized company in our space, about $1.3 billion that we do the account documentation for. And the nice thing about being kind of medium-sized is we have enough experience that we've seen pretty much everything. And we're still small enough that you can actually get us on the phone and talk to us about a particular idea or chat about a strategy. So again, personal service is really where we feel like we excel, and we'd love to be part of your investment strategy. We also are big believers in learning, so events like this. We also have pre-recorded video library, and our blog is very up to date about current topics and issues and things that are happening in the investing world as well as the self-directed IRA world. So please do feel free to avail yourself of all of our learning resources, because an educated investor is one that is more prepared to react to what's going on in the investing marketplace. And just in case somebody is really new to the process, what we're talking about here is tax advantaged accounts that invest in quote unquote alternative assets, so things kind of outside of publicly traded securities like stocks and mutual funds. The account types are exactly the same as you're familiar with, so traditional IRA, Roth IRA, solo 401k. We also do employer plans like SEP and Simple. And a lot of people don't know that health savings accounts also are individual custodial accounts and can be invested into these alternative assets just the same as an IRA. So if you have an HSA, you might be able to partner that together with another tax advantaged account so that you can start growing that health savings account balance as well. And it's a very common procedure for somebody to have left a job or even a couple of jobs and have old 401ks or other tax advantage plans there that are still kind of left over with the previous employer. A lot of times somebody opens an account with us, they do a rollover of those funds to kind of get started in terms of their alternative investing strategies. So that's also a very common scenario for us. But keep in mind that the account types are the same. The tax advantages are the same. Contribution and distribution rules are the same. The only thing that's really changing is the assets that the account purchases to grow. So we handle real estate, we handle precious metals, all kinds of private lending, which we're going to be delving into today, as well as private equity. In fact, almost anything that you know how to make money at outside your IRA, you can make money at inside your IRA, as long as you take the time to set it up properly with an account provider that knows how to handle that asset. So again, account type's the same, assets are different, and you're actually the one who chooses those. So we do not give any tax, legal, or investment advice, as I mentioned. So you actually bring the strategy as well as any professional expertise that you need to invest those funds. You bring that to the table, and you get to exercise that expertise of you or your teams. Now, as we're talking about private lending, there are some things to think about. That's kind of a broad asset category. So an IRA can actually originate notes, or it can buy existing notes. Either of those is totally fine. It can be secured or unsecured by collateral. So in the case of a real estate-based loan, a lot of times the real estate is acting as a security, but the IRS does not say that you have to have collateral as part of the note. So from an IRA holder's perspective, you have a lot of latitude in the way that you design a note or participate in a note. Some of the notes that we have seen have equity participation in addition to an interest rate. And some of the lending or debt strategies that we see are actually investments of equity into a fund or something like that, but the fund itself is loaning that money out. So there are a couple of different ways that the loan product can be organized. Certainly your IRA is able to participate in whole loans or fractional. The only real restrictions that the IRS puts on the debt products are, first of all, you can't loan to a disqualified person. There's a small group of people, mostly close family, that your IRA has some restrictions about interacting with from a financial perspective. And it does have to be a real economic transaction. In other words, you can't make a sweetheart loan to somebody that you never expect them to pay it back. So, but as long as you stay in those general parameters, the IRS actually lets you craft your lending strategy with very little limitation. Things that you might think about, again, your IRA investing strategy, you are the person who does the due diligence and makes the strategy decisions. So it is important for you to take into account all the things that you need to make sure that you are in the product that you want. So think about the amount that's being borrowed, interest rate, the length of the term, when is it going to pay off, is there a balloon payment, does that meet your financial strategy? Again, is there equity participation, those types of things. And you know, the payment due, and again, the repayment strategy is often something that comes into play because you are thinking about, hey, this is my retirement account, I may need to be taking distributions at that time, or I may not, and that can affect the type of product that you're in. So all of these types of decisions are ones that you want to take into account when you're deciding how you're going to participate in a debt instrument. And you know, in terms of getting your IRA involved in a debt instrument like this or a private lending product, it's really a pretty easy process. So I mentioned the fact that a lot of people do rollovers from old 401ks or old employer accounts. So the process is really easy. You open an account with Advanta, that gives the money a place to go. You do a transfer, rollover, or contribution, or some combination of those from an old 401k or IRAs that you already have. You move that money over to your Advanta IRA, and then you're actually ready to invest. So you will go out and you will find your private lending instrument that you want to be involved in, negotiate the terms of your investment, and we will help you with the paperwork to document that activity so that you get to keep the tax advantages while you receive the returns. So it's really as simple as that, and we're happy to talk to you about your investing strategy at any point, so please feel free to give us a call. Now, I've laid some things out from self-directed IRA perspective, and Emiliano is going to come on here in a moment, and he's going to be talking about some more in-depth topics on private lending. But I do want to encourage you to type in questions. So if you see questions in your area in your console, or your GoToWebinar kind of console there, please go ahead and type those in. We're happy to answer all your questions after the presentation. So as they occur, you go ahead and type them in, and we will answer them at the end of the presentation. So at the moment, I'm going to turn things over to Emiliano Zapata, CEO of Capital Insiders. Again, welcome, Emiliano. Thanks a lot for joining me today.
Thank you, Clay, for having me over.
Great.
Appreciate it.
And I think I gave the screen permission to you, so let's go ahead and get you set up with your screen there. Do you have that? There you go.
Are we ready?
Fantastic. So again, for everybody who's listening, Emiliano is a very experienced private lender, and he's going to talk a little bit about his business and how he sees the business, and hopefully we can learn a few things about our own private lending strategies. And really appreciate you sharing your expertise today, and I'm going to let you take it away, Emiliano.
Thank you, everyone, for joining this morning. Before we start, I want to say that I'm not an attorney, I'm not a CPA, I'm not a financial advisor. You must want to talk to your team before you can make an investment. I'm the CEO and founder of Capital Insiders. We are a lending and investment firm that provide capital and expertise to local real estate investors like operators, landlords, managers, builders, and developers in the state of Texas. So I'm going to say who we are and what we do. We are a private equity real estate investment firm. What we do is we manage a portfolio of investments in real estate. We invest in both debt and equity, commercial and residential. Residential only for investment purposes, not owner occupied. And besides the capital, the real estate investors can get almost anywhere in America, we provide expertise. This is something that sets us apart from the other private lenders. How we do it? We are not the typical the hard money lender. Hard money lenders are used to get a phone call from the real estate investors, and the first question that they ask is, how much is going to be my interest rate? We don't work on that way. We actually work on the opposite side. We go out there and look for the best and brightest real estate investors. We see what the projects are doing, and if we like to join them, we offer them capital, and besides the expertise that we have. Again, we are very, very focused on the small balance real estate industry, which is highly fragmented, and that is called SBRE, which is small balance real estate, and they go between 100,000 to 1.5 million. We have been, before we became hard money lenders or private money lenders, we were builders and developers in the state of Texas. We were for about 25 years in the industry. We built over 2,000 units, residential, multifamily, and commercial. So we have expertise from design, due diligence, construction, structured finance. We manage the property, we market it, and we sell them. So we have been around in this industry. So it's important to say what we don't do, because this is a very common mistake that some investors think that we are going to be there to buy properties, to manage those properties, and sell those properties. That's not what we do. We don't develop, build, or manage any properties. We only provide the capital and expertise to those who have the experience as well. So our investment approach, it's based on capital preservation, consistent income, and deal size. And we based our investments on value, and we focus to deliver returns, constant and conservative risk adjustment returns to the investors. Again, capital preservation, consistent income, and deal size. The capital preservation, we do a lot of due diligence. We are very prudent on underwriting. We manage risk. Those investments are very short, and we only lend up to 70%. So we have a downside protection. We focus on the consistent income to deliver to our investors, monthly distributions, reimbursement options, preferred return, and always senior position. We focus in investments only between 100 and 1.5 million. We diversify our asset allocation. Local knowledge is very important. We don't lend through the states. We focus in Texas, and we only lend to very well experienced real estate investors. So how do we mitigate risk? Okay, we do it in a different ways. We diversify. Number one, as I mentioned before, we are not the type of company that we're going to get a call and says, I need $100,000. How much are your interest rates? We don't work in that way. We do an extensive and deep due diligence, and we underwrite the company and we underwrite the principles of the company before we can make any business with them. Experience, it's a must. Credit, collateral, asset type, asset class, and geography is one of the ways that we diversify our loans. The asset class, commercial, residential, not owner occupied, multifamily, self-storage, retail, health industry, office, senior housing, and light industrial. The geography, main cities, not too much in love with downtown, neither Austin, Dallas, Houston, San Antonio. We go to the suburbs. Small balance, $100,000 to 1 million, loan to value no more than 70%. Those loans are non-institutional, and Wall Street is not going to pay attention to those loans. That's not what they focus on. One of the most important things to consider when you want to make an investment, and we understand that real estate investors, they can go by their own, buy a house, fix it and flip it. In order to be a successful real estate investor, deal flow is very important to consider, because the more opportunity that you see, the more qualified you can get. And then you have a choice to pick and choose which one you want to go. And this is something that we do very well, because we get a great deal flow, and we probably invest in less than 10% of the properties that we see, or the opportunities that we see out there. I'm going to go back right here. Another point that we want to discuss today, it's about construction loans and why we feel very comfortable with those. Number one, construction loans are very, most of the construction loans in America are done by local banks, regional banks and community banks. They are very focused on those construction loans, and they know very well the geographical area that they serve. And most builders and developers, it's probably the only source of money that they can get. Now, when they come with a private lending, you have to go to a specialized construction lender, because we understand how the process works, and this is extremely important. I mean, there is a lot of risk in the construction, and it's, in order to be a successful lender, you have to have the experience to underwrite those loans. And there is a misunderstanding, and it's a lack of information, lack of knowledge on small real estate investors on how to underwrite commercial properties. On the residential side, it's kind of easy, if you want to call them that way, because you purchase the property, you know how much money you're going to put in, you see your expected returns, and that's basically value. Of course, you base your information, you get an appraisal, see how much is going to be the property, how much is going to be appraised for after you finalize your project. And on a residential side, I believe you don't require too much knowledge to make a good decision. When it comes to multifamily and commercial properties, it's completely different. The cost of the land and the cost of the construction is not related with the value. And that's where the big mistake comes from small builders, small developers. They believe that they can buy a piece of property, put either a multifamily apartment complex or a strip mall, a small commercial plaza, and they see, okay, I'm going to spend $250,000 on the land plus $758,000 on my construction. It's $1 million, and I'm going to sell it for 1.3 or 1.5, whatever the case might be. That doesn't work that way. The way a commercial property or a multifamily is going to be underwritten is very simple. It's based on the income that produce. Now, because it's a new construction, who knows what is going to be the future income? That's where local expertise come in place. That's why a bank from outside your geographical area, if you are in Dallas or in Houston, a bank outside those areas is not going to lend on construction. More likely, is not going to do the loan because they don't have the deep expertise, the boots on the ground that you require to see how much is going to be your rent. Of course, there is a lot of data these days on the internet. You can pull almost any information, but looking into the surrounding areas beyond the actual property is going to give you a good insight if you are going to be able to get the rents that you are trying to get. Now, once you get your rents, which is going to be your income, now you can predict which is going to be your value of the property, and based on the value, you as an investor, you decide how much money you want to lend. In our case, we are extremely conservative. We do only up to 70% of the loan to value. We want to play with 30% of downside. Of course, that was pre-COVID. Now with COVID, we can pull up to 60% because we want to be very comfortable with the risk that we are taking. Now, let me say this one. Commercial properties, they're getting very tough to get a construction loan. Right now, we are not doing construction loan on commercial properties, retail or shopping centers. We focus on multifamily because housing is a need. We know that it's going to be, it has been for many years, the best performers. Multifamily, when it comes to commercial real estate, is the #1 performance. So it outperforms office, commercial, light industrial, you name it. So it's important for you guys to make a deep understanding if you are trying to do a loan on a new construction. There is many factors to be in consideration, and those are pre-loan or pre-closing. Once you close the loan, that's completely different story, because the draw system is the one that's going to take you the risk in your side. Per se, you want to lend XYZ percentage of the land, and the borrower is going to come with the other percentage so you can close. Now, you never ever advance any money without seeing a due diligence on the construction. If let's say that they already got approval by the city to pour concrete, they already got approval by the city to start framing, or to continue with the framing, to do the sheetrock or the insulation. All these steps are critical because you never give money in front, and it's always a reimburse. That means the builder has to have the capabilities to pay for those in advance, bring you the receipts, and a lot of paperwork needs to be done, sign it, because we need to request for lien releases before we can release the money. And we also put another strength, it's we only give them up to 90% of the invoices paid. We want to be very conservative. This is the most critical part, because from one day to another, the construction can go south, because if you overdraw, the builder is going to spend the money. I was a builder for 25 years, and I know what I'm talking about. And I know that the more money that we can get, the more money we're going to spend. So this is something that we don't allow to do with the builders. So if you guys are considering to invest in construction loans, feel free to give us a call or send us a message, or anything that you may have question. I'll be happy to help you with your questions. So the investment opportunities that we present in our company, they are 3. We have senior notes, lending fund, and preferred equity. So senior notes is the less risk and is a conservative return. Lending fund is when we can go up to 70%, and we have distributions monthly. I will say conservative returns as well, and commitments are for 24 months. Equity participation, there is also something that not too many companies offer, preferred equity to their investors. We do have a program for those investors who are willing to take a little bit of risk. It's a risk that we measure very well, and is very conservative as well. So that's another, besides the lending fund, some other investors will like to participate with qualified real estate investors or builders and developers, and we offer those capabilities as well. In our fund, we offer a Reg D 506C. We only lend to commercial, multifamily, and residential investment. All our loans are secured by first lien deed of trust only. The minimum offering it's 100 million. I'm gonna say this, and I think that's why we start having this conversation, Clay and I. I just noticed on his previous presentation that he said that he's 1.3 billion the company, and is still considered small to handle the investors the company has. Before the COVID, pre-COVID, I talked to Clay and I told him every single week we got a call from institutional capital trying to deploy capital through us on very, I will say, crazy numbers. They will wanted to give us 25 million, 50 million, 100 million. That's something that we are not considering to do. That's not a model business. I was talking to Clay and tell him, see, these companies from New York, they have too much money on the sidelines. If they want to send you $5 million, $10 million on a month, we don't have those capabilities to deploy, and we don't want to be there. We want to be conservative, because the more money that we can get, the problem can be, it could be easy the way that we underwrite deals. So mistakes are going to happen. We don't want to go that route. We don't see our fund going from 100 million to 300 million to $1 billion, because that's where we don't want to be that company. Very honest, we don't want to be a $1 billion company. We want to keep it small. We want to serve well the investors, and that's the way that we choose to be. So we prefer to have one-on-one meetings, face-to-face meetings, knowing our investors, knowing and understanding what they want to do, what is the plan of investments. So we just got registered during this pandemic on March 25th, 2020, something that we didn't expect because what was happening, but the SEC gave us the green light to go. So open-ended evergreen fund, accredited investors only, minimum investment 100,000. Yes, you can use your IRA account, and yes, you can reinvest. If you don't want to take your monthly distribution, you can put it back. So we have a third-party administrator, and the audits are from Spiegel Accounting.
Hey, Emiliano, can I interrupt you for a second?
Sure.
I just wanted to, so you had mentioned the fact that there is, in certain loans, there are failures, whether they're based on not doing due diligence or not setting it up properly. What does that look like? What happens when a loan fails, and what are some examples of the loan failing?
Okay, if we speak about construction, I can tell you the number one problem is going to be not paying attention to the progress of the construction. We like to do a weekly visits to every single construction loan that we have out there. We want to make sure that the builder is performing. With our experience, we can tell in a week if he is paying or not the subs. The only reason why a construction stops is because there is no payment to the subs. There is no payment to the electrician, to the plumber. They are not going to go back. If you pay them on time, they are going to come back week after week. Now, you have a schedule. You know exactly when you're going to put concrete, when are you going to put your MIP, which is electrical, plumbing, and AC. You know when insulation is need to come, and you know every single step. You cannot put insulation without getting a city approval for your MIP. You cannot push your rock if you don't get an approval by the city for your insulation. And the things goes on and on. Before we can release a payment, we require the certification of the city. The city inspection has to be in our industry. It's either a red or a green tag. The city is going to give you the red or the green. And as a part of the draw process, they give us a call to say, I need a draw. They don't need to know, and they don't need to ask, oh, I need $100,000. That's not the way the construction work goes. The builder says, I'm gonna need a draw by the Friday. It's Monday. Okay, we send out a third-party inspector, which is very important. Let me say this. So yes, we have experience. We have a lot of experience in construction. However, because we manage a fund, we would like to have, we decide to have a third-party company making those inspections because we want to have an extra layer of protection when it comes to the fund. So there is companies out there that they specialize on inspections, and they can go by the schedule of the work. It says, okay, plumbing is already done, electricity is already done. Now, based on the draw sheet that we have, it says, okay, if you complete electricity and plumbing, you're gonna get 17% of your loan. And out of the 17%, I'm gonna give you only 90% because I still gonna keep a 10% at the very end. So when you bring me the certificate of occupancy by the city is when I'm gonna release the last 10%. So we keep an eye extremely close with money because we don't want them never give more money than is needed, number one, and we want to make sure that the project is progressing according to the schedule. They said, okay, I'm going to build a residential home and it's going to take me 6 months. Okay, we know by week what is need to be done. Not because we already have the experience. It's because we also have a piece of paper that it goes on a schedule. Okay, week number 1, foundation, week number 2, framing, week number 3, MIP, week number 4, until you have the 12 or 15 or 16 weeks, whatever it might be. Every single step, we take we do inspections on a weekly basis. I personally drive to those places. I used to drive before pre-COVID, 3,000 miles a month. Check on because it's extremely important before you can do the loan, Clay. See, okay, I'm gonna do a construction loan, and it's gonna. I need to see where the neighborhood is. I need how it looks like, because the first thing that I need to think before I can do the loan is, what am I going to do with this property if I take it back? Okay, what am I going to do? If it is important for me to know if across the street there is a park, a church, a library, or a men's club. All these things play a big role on the investment, and I'm doing it as it was my own investment. I'm not going to make a loan knowing that this subdivision, the residential, is across the street of men's club. I mean, I know that it's going to be, value is not going to be there. And we have the decision to say yes or no. So we don't need to ask any permission to anybody. If I don't want to, if we don't feel comfortable, we don't feel comfortable, period. There's no more explanations. Yeah, the deal can be great. I mean, could be 40, 50% loan to value. I mean, you can tell me it's going to be great return of investment, but we don't feel comfortable. We don't feel comfortable.
So is it safe to say, Emiliano, that the playbook then is the coordination between the construction schedule and the draw schedule? That's something that you set up kind of as you're setting up the loan and you agree to do it, and then that's kind of the playbook that you go from at that point?
Absolutely. But let me tell you something else. Before we do a loan, and before we underwrite the loan, we underwrite the company, we underwrite the principals. We want to make sure that we feel comfortable doing business with the principals of the company, because the deal can be great. I mean, that's not a question. The subdivision can, or the commercial property could be sitting on Main Street. That's perfect. But if you don't feel comfortable with the people that you're doing business, I mean, it doesn't mean anything. Because if you know the builder / developer is going to perform, and they have ethics to perform, even if a COVID-19 shows up, because we got caught with some construction loans in the middle of that. I mean, and of course, we got a lot of calls from our investors to say, Emiliano, what's going on with these construction loans? So because we underwrote the builder, we knew that the payments will come, regardless if the construction will continue, because in this part of the country where the governor says nobody's going to go work, I mean, you cannot enforce the builders to say we need to keep going with construction. But we knew that the payments will come because this particular builder / developer has the financial capabilities to perform. I understand it's not going to be 100% of the cases. Some real estate developers and builders will have more financial capabilities than others. And you might think, well, if they have financial capabilities and they have a AAA credit, why are they going to come to a private lender? Well, that's a completely different story. We can have another webinar about that one. But between a bank and a private lender, they will choose a private lender 99% of the time. So, and I said, we can have another webinar for that particular topic. But going back to your question is, yes, it's your Bible, the schedule, timing and the pricing. That is very important to keep the price on their schedule as well, because it's unbelievable what we have seen in this market today. The prices of the houses in America on June, they jumped 24%. So the lumber, so the labor. So if we start a project on January, February, and you had like a $50 per square foot in construction, and out of the blue is 55, who's going to cover that 10%? On $1 million project, it's 100,000. So it's a lot to be in consideration. You have to be very, very careful how to underwrite and how to follow your schedule. And any variation on construction has to be paid upfront by the borrower, upfront. If not, we don't continue. They know that they have like a 5% contingency on every single draw. We request them to have it on their schedule, because we don't know what's going to happen. It's good to have it and not to use it, but if you don't have the 5% contingency and the lumber and materials jump 10%, you are underwater. There is no way that you're going to finalize the construction.
Okay, great. Thank you for letting me interrupt. I'm going to let you go back to your slides, and we'll answer questions at the end. Yep.
Okay. So this is something else that we had a long discussion with our attorneys when we put this offering together. It's preferred alignment. What does that mean? In this industry, investors, real estate investors, they have thousands and thousands of options. I believe it is over 9,000 private placement memorandums in the real estate only, besides the oil and gas and minerals and gold and all kind of stuff. I have not seen ones when they offer the money of the money of the owner of the company or the manager, and in this case myself, to be in front of the investors. So most offering states that they have alignment with their investors. What does that mean? That means, in a very simple way, if an investor puts 100,000, my company or myself, I'm going to put $100,000. And if something goes south with one loan and we lost $10,000 per se, the investor is going to lose 5,000 and I'm going to lose 5,000. So that's to be aligned. That's what is called alignment in this industry, which I perfectly understand and I agree with it. I mean, if I'm in the fund and I have an investor, only one investor, and the fund loses 10,000, investor is going to lose 5,000 and I'm going to lose 5,000. I think that's normal in this industry. So how can we differentiate from those? Okay, what we're seeing is this. If we have one investor with 100,000 and I have personally $100,000 and the fund for whatever reason loses $10,000, my money comes first when it comes to the investor. My money, I'm going to be with 90,000 and the investor is going to still keep the 100,000. I might not be able to get returns, but I don't want them to lose capital. Now, I have limits that we can disclose later, but I can tell you my money goes first all the time. That's something that we decide to do it, and we want to keep it that way. We work with the most professional people in this industry. Private lending has now becoming an institutional grade. We have many companies from Wall Street jumping into this space. And it happens in the last few years. I'm going to say 5 to 8 years. Last year, they were the #1 capital suppliers in this industry. They have all the power and they have all the capital in the world to jump into this industry. There is one way to do it. You can join those funds, big funds, billion-dollar funds. We are not going to be there. We don't like to be there. So when I say institutional quality is, since this industry has specialized a lot, so we have hired and retained the best attorneys for real estate, not for real estate only, for private lending in real estate, same as accountants. They specialize on private lending funds. So we work with those companies to ensure that our fund is working properly so we can deliver a good performance to our investors. That's what we call institutional quality. So here are the loan programs that we serve. And I'm sorry. So we do fix and flips only to those who have a company who do fix and flips. What does that mean? We do not make a loan for the mom and pop that they just bought the first house and they want to paint it. And I mean, that's not our model, because fix and flip it's a whole industry, and the fix and flippers are always going to call you, what is your interest rate? They don't have any interest to develop a relationship with the lender, and we don't work on that way. We look for investors who have a company who specialize on fix and flips, that they can do 10, 20, 30 fix or more on a year. We like to sit down, we see what is the business plan, and if we like it, we join them. And because at that point, interest rates are no longer the primary thing. It's just the resource of the money, so they can have the money when they need it and they can close pretty fast. That's more important than interest rates. But when you're a beginner, interest rate is a huge thing, so you have to have in consideration. Construction loans, of course, that's where we specialize. Multifamily is one of our best models. There is so many small investors, builders, developers doing fourplexes, duplexes, triplexes, because that's all they know. But when it comes to multifamily, and again, I'm saying this, Clay, when you go to duplexes, triplexes, and fourplexes, that's a residential loan. That's the law. It's going 1 to 4. Those loans are underwritten completely different. When you have a 5-unit, 7-unit, or 20-unit complex, the underwriting is completely different. Yes, if you're a builder slash developer, you can do as many as you want on a single family, duplexes, triplexes, fourplexes, because you can underwrite those yourself. Very easy. I'm not saying that you cannot underwrite the largest one. I'm just saying that it's more complicated, and there is more than brick and mortar and the 2x4s. It goes from one thing to completely different. I mean, the underwriter of commercial loan is completely different. That's what I'm going to say, and it's a little bit more complicated. So there is a lot of rental people that they are finding. They want to grow their own portfolios. They want to start putting 2-3 houses together. They want a rental property, and of course, we don't do 30-year loans. We only do up to 12, probably up to 18 months. What we call by rentals is they acquire a rental property, and we just underwrite the income coming from that rental is going to be able to pay us. We don't lend the money just because we want to lend money. Is we want to make sure that we're going to get paid by the income, regardless of the secondary source of income the developer may have. We want to make sure that that property performs the way it is. If we need to take it back. Bridge loans, I mean, I guess everybody understands those. It's a very short-term loan. It's just to put you from point A to point B. Commercial properties, multifamily, and notes. There is some sophisticated investors that all they do is buying and selling real estate notes. And when they come with a good deal, they need to have cash in hands, and they can come to us, and they come to us and says, okay, I have this real estate note that we want to buy. We understand the note business very well, because that's what we do. We originate notes, and we can make those loans. So when it comes to property types, yes, single family for investment purposes only, multifamily, hospitality, which we are not doing anything in hospitality right now, of course, mixed-use properties, retail centers, senior housing, which is another big segment of the market. Senior housing is growing. Any city has those shopping centers, again, 1 to 4, daycares, light industrial, office buildings, self-storage, strip mall, land development. When it comes to land development, again, I think there is only one source of money for those. It's the banks, period. Land development take forever to get approvals by the city. They might take 6, 9 to 12 months. And if you are in cities like Austin, it might take 2 years. So land development is a very specialized line that we have. We understand land development because that's what we did for 20 years. That's where we feel very comfortable doing those loans. And developers trying to acquire land to develop, they understand that going through the bank for a land development might take at least 6 months to get a loan. With us, we can underwrite the property, and we can close 7 to 10 days if we like the deal, because we understand. So that's why experienced land developers, we can talk the same language. So, and they see it right away. They see that we speak the same language. Sometimes they get very, I mean, surprised. And because of course they don't know that we were developers builders before, because they think that when they call a private lender, is they just call in an ex-banker. So I guess that's it. You can call us, email us, or visit us when it is convenient for you guys. And I highly appreciate the time and all the attention that you have given me this morning, Clay.
Well, thanks, Emiliano. I appreciate your time as well. Let me go ahead and thanks for putting up your contact information and your willingness to do that. And I'm going to actually put up a screen that has both of our contact information on it so that people can reach out to either of us with further questions or anything that comes up. And we do have a few minutes here, so I'm going to ask some of the questions that are being typed in by the audience if you have a moment. So here we go. So there's actually a couple of questions about your personal background. So they're doing their due diligence on you as well. So
Okay.
is this your first fund, or do you have some sort of historical performance that you can share, or how do you do that?
This is the first fund. Let me tell you this. When I started 20 years ago, of course, I started with my own money and bank's money. I went to the bank and got a loan, and then another one and another one. And then if you want to grow, you want to go to friends and family, but you realize that you only have 2 family members, so you need to go outside your circle. So I did, and I went to visit different investors. And probably the last 15 years, I've been working as a, you want to call them syndicator, uh, because it was not my own money, it was somebody else's money. I can tell you, Clay, that I'm in this business because they pushed me to be in this business, not because I choose to be in this business. On the lending side, on my last year of a builder developer, of course, my projects, they were very big, 15 to 20 million dollar. This is something that the banks get very, very scared, and they want to know who you are, what you do. And in order to raise 30% equity on a $20 million project, $6 million, it's almost impossible. It's not going to be one person to tell you, oh, here you go, $5 million, $6 million check, let's go and build. That's not going to happen. You have to put a pool of investors and do your presentation. So that is what we call syndicators. And for that, I want to say the last 10 years of my career, that's what I did. So, and I found 2 things. Investors are investors are investors. They don't care about how beautiful your project is. They just want their money back plus a profit, which I understood very well. I'm an engineer. I'm a very good with numbers. I'm extremely good with numbers, and I'm very good underwriting properties. So I realized that the business was finance, no construction. So 2x4s, I love them, but if they don't make any money, they don't make any money. So this is my first fund, yes, but it's not my first rodeo. I've been doing it on a syndication basis. We have loans today because we got caught in the middle of the COVID that they are on a syndication basis. If some of the people want to be in contact with us, and we can provide information about the current loans, how we do it, and yes, of course, to share with them some performance. Absolutely.
And so there's a couple questions actually about your fund administrator. So who is your fund administrator, Emiliano?
We have choose to work with Fairway America. Mark, it's Matt Burke is one of the most experienced guys in this industry. He has his own company, Fairway America, and they later on found that this space was underserved, and they created a company just to 2 things: to help real estate entrepreneurs to put funds together, but at the same time to administrate those funds. We choose to work with Redwood. Now they changed the name, but it's the same company, the same principles. I don't know why they changed the name, but that is what it is. They just changed the name. It's the same company, the same person, and they are the most, to me, they are the most knowledgeable people for small funds, anywhere between $10 million to $200 million. They not specialize on 500 or $1 billion funds. They know this industry very well, so that's why we choose to work with them. Fairware America. You can check on those.
So next question, does the borrower provide personal guarantees? And there's a follow-up question after that.
Absolutely. Yes, every single member of the LLC has to sign personal warranty. Yes.
Okay. And let's see. In case of a default, how fast do you notify the investors and do you inform them of the status of the collection process?
Okay. We open a sister company called Not Insiders, which they are doing the servicing of our loans. We keep the servicing in-house because we want to keep an eye very, very close. We have the system in place to get a notification, and in Texas, in order to get a property back, you have to follow all the steps. So if we don't get the payment by the 6th day of the week of the month, so they have from the 1st to the 5th. If we don't get it in the 6th, we send out this is a friendly reminder, yada, yada, yada. If your check is in the mail, thank you. But if not, this. Day number 10, we don't get it, we send out the first notice from the attorney's office, not from our office, from the attorney's office. Second and third. So we have all the paperwork in place to be able to recoup the property on 41 days because that's what the law allows if we do all the steps accordingly.
So I wanted to ask you a couple of things that popped into my head too, just in terms of our previous discussion and what we've been talking about today. So it's you've described yourself as a relatively conservative lender a couple of times. I mean, so I'm assuming that there are less conservative lenders out there. Is that accurate?
Well, if you have private lenders with some kind of institutional grade, they all want to push for LTVs. Some people wants to go 70, 75, 80, because on the other end, you have the borrower who only wants to have more money. That's a game. We don't chase those deals. We don't chase to do 75, 80% loan to value. There is many. Now, in our case, we keep up to 70% loan to value, but we also have another checkbox that has to be done regardless. We only do 85% of the purchase price. On every single loan, the borrower must have to come with 15%. I'm going to explain this simple. The loan to value might be $200,000, but if the purchase price it's 100, the borrower is going to come back to me and say, Emiliano, why you need more money if you already have 50% loan to value? I don't care if it is 50% loan to value. You have to come with 15% of your purchase price. I can only lend you up to 85% or 85,000 because I want them to have some skin in the game. Otherwise, they can walk away at any time. That will bring automatically my loan to value less than 70% on any case. So even if it is a very tight, I'm going to be on 68, 69, probably 70. It's going to be difficult to find a deal that we have with 71% loan to value because of the 85% loan to cost to purchase price. That's something you can tell if somebody's going to, Emiliano, why you asking me for 15%? That man doesn't have any money. That's not the borrower that we want to work. We want to work with people that they already have money to perform this because we understand that they have more deals as well. They're not working exclusively with us. They have more deals. So now on the private lending side, if you go to the hard money lenders, non-institutional, Uncle Rich, he might do 50%, 60%, 90%, wherever he feels comfortable with. So if I go with you, hey Clay, can you borrow me 100% of this house and its value, the loan to value is going to be 33%? You might say yes. I mean, there is no rules and regulations. It's your money. You can do whatever. In our case, because we are managing somebody else's money, we have two check boxes that we have to check. No more than 70% loan to value, no more than 85% loan to cost, purchase price, period.
And
I'm going to say this. It's a battle, and it's the first discussion that we have with builders. Let me tell you, I was a builder. I know how the system works. You go to the bank, you push a little bit the numbers, and chances are that you can get between 90 and 100% of your costs because you can manipulate your numbers. You are the builder. So we don't do that. We check the cost. We have a third-party company that is going to check also the cost, the current cost, and then we can come back and say, okay, Mr. Builder, we can only give you 85%, regardless. Regardless, I don't care how much profit they have on the deal. If it is a property that they have on the contract, they are result. We don't go by futures. We do what we do on this date.
So one of the questions is, so how did you establish your deal flow? I mean, it sounds like you have a maybe an unusual background, but how did you establish the deal flow that you have? Because it sounds like, if I remember what you said correctly, you're actually only loaning on 10% of the applications or something like that. So how do you get enough people applying, I guess?
Okay, so because we work backwards, we don't have a 1-800 number and says, hey, we have money, call me. Because, and that's what happened if you have a fund with 200, 300, or $1 billion. Now you have to deploy that money. It cannot be sitting in your desk. That's a huge liability for you as a fund manager. When those things happens, your underwriting criteria can come a little bit lower, and then you can have a higher risk. So since we don't have a 1-800 number saying we have money, just give me a call, we go through the builders. We drive the neighborhoods. We know the market. We know what is happening on XYZ neighborhoods. It's okay. This is a residential. It's getting, now we see who the developers or builders are, and then we approach them. Says, okay, I know that you're going to build houses here in this subdivision. What is your business plan? How many houses are you going to build? Are you going to build one on a subdivision with 100? How big is your market share in this particular area? Or are you building 10 a year and you want to go from 10 to 20? How can we sit down and have a business plan? Do you have a Facebook account? Do you have an internet? Do you have today capabilities to show your houses via the internet? Because shoppers are very afraid to go out there, so they want to see the houses. If they don't have those capabilities in house, we can either tell them, hey, we would like to work with you. Let's put a plan together, but we are not going to be just sitting there, just waiting for a call. Do you have money? Because if we got that call, it's because they are looking for cheap interest rates, which we don't have those cheap interest rates. We have a business plan, and the way that we present ourselves, either they like or not, we are a big investor on their project. If they are going to do 20 apartments and we're going to supply 85% of the money for the construction, we are the investor number one in that project. And I want to make sure that they have the capabilities. So we go and look for the best real estate investors, real estate developers, the best fix and flippers. We go out there and we try to sit down, and sometimes they don't want to work with us because they have cheaper money, which is that's fine, but that is what it is.
Got it. Got it. And did I also see that there's a question here about how to invest with you guys and some of the details of that? I think I remember from one of your slides that there was at least 3 different kind of ways to invest with you. You want to talk a little bit about that before we close up?
Sure. We have the fund, right, which is the Reg D 506C. They can invest $100,000. It's a 24 months period. If they don't feel comfortable with 24 months and they feel like, oh, well, no, I don't want to be here, I think it's too long, or I don't like the 70% loan to value, I would rather do the 50-55. Okay, we have those 2 investment vehicles outside the fund. Per se, we do a loan, and somebody, you and I can say this, Clay, and I want to put this example. Let's say that we have a borrower and they are looking for $100,000, and then you say, Emiliano, well, I don't feel comfortable with 100,000, but I can do 70,000. Can you put the other 30? It says, yes, of course. So your risk, so Clay, you are on XYZ and I'm on a different level. So if you don't feel comfortable going through 70% loan to value, you feel comfortable going between anywhere between 50 and 55, we'll do the deal together. And that's one way. Now, on the other extreme, on the other side, it's, hey, Emiliano, I feel comfortable with these investors that you are working with, the developers, and the price that they're putting together. I would like to have a participation. I would like to be part of that team. It says, okay, we do equity. We do prefer equity. That means this. Good builders and good developers, they have 3 or 4 projects at once. sometimes they have more products than the one that they can put. If I'm asking 15% of their money on every single one, they might say, okay, I can only do 2, but I cannot do the third one. And I said, okay, I have an investor who can join your team, and he can come with 5% or 10% or XYZ percent of that 15%. And they said, okay, great. So that's where we bring those investors, and we only do those when we are the lenders. We don't want to expose an investor going on the preferred side and then get along with the XYZ bank. We will never do that. So we have to have full control of the operation. And so if we have a deal that is very good one, and we have investors that say, Emiliano, just give me a call when you have a good deal. I'm looking for XYZ returns. And then we call Mr. Investor, hey, this is a good project that we see. Please take a look and let us know. And those are on a case-by-case basis. Oh, I like this apartment complex, or I like this commercial property. It's people that they don't feel comfortable going into the fund system. They just want to be on a deal-by-deal basis. So on a deal-by-deal basis, we offer the 50 to 55% LTV or the preferred return, whatever they like.
So I appreciate you spending time with us today and bringing your expertise. And I feel like I heard a lot of things that I can use as an investor, both in if I want to go small time or even if I grow. But I just so that folks are out there who are attended the presentation, do you mind if they call and ask you about the techniques that you use and how you see lending and that kind of stuff? Are you open to that kind of thing?
Let me tell you, Clay, once we have an investor that they said, hey, I'm interested to learn more, we visit them. A phone call is good to open the conversation. It is very good. I'm open to have those conversations. Zoom meetings now these days. But if they feel comfortable, I'll ask them if they will feel comfortable, of course, pre-COVID and all kind of stuff, to meeting on a face-to-face, because I want to make sure that they understand what we do and they feel comfortable with me, because at the end of the day, I'm the one making decisions on behalf of the fund, and I want them to be comfortable. If there is something that they notice on an eye contact that they don't like it, I would prefer to have that conversation up front, not later.
And I also know that you're willing to share your slides, and that's the web address that you see there underneath the Capital Insiders logo, everybody. So Emiliano was nice enough to get the slides together so that you could download them, and that's where you can get a hold of them. So again, thanks everybody for joining us. I hope it was informational for you, and that you gathered something new for your investing arsenal. And Emiliano, thanks so much for joining us, and I hope you have a great rest of the day. Yeah. And everybody else, have a great rest of the day, and happy investing.
Thank you.